Okay. Good evening, everyone. I, CA Sankalp Pitalia, welcome you all for the insightful webinar on topic TDS on payments to non-residents under Section 195, practical issues and litigation insights. This webinar is being conducted by Committee of International Taxation. Uh, in this webinar, we have our CCMs, respective CCMs, CA Sanjay Agrawal sir, CA Satish Gupta sir, CA Vishnu Agrawal sir. Let me go through uh, the CA Vishnu Agrawal sir is our Vice Chairman of International Taxation Committee. Then CS Satish Gupta sir. He is currently serving as Chairman of International Taxation Committee of Institute of Chartered Accountants of India. In addition, he holds the position of Chairman of Aggregation of CA Firms Committee and serves as the Vice Chairman of the Board of Studies Academic for the current term. He is prolific speaker and writer and has authored numerous articles and delivered insightful lectures at seminars, residential refresher course, and webinars across the country. His core area of expertise include.
Uncle, let me invite and introduce Sanjay Agrawal sir. Sanjay Agrawal sir is the very senior council member and he had been the chairman of this committee. He had been the chairman of aggregation of CA Firm Committee immediately preceding year. He is a versatile personality and is academically very strong in tax side. And we are lucky enough that he has spared some of the time for this particular webinar. So I would request first to Sanjay Agrawal sir, kindly address our members who are in very large number, around 1,000 members are attending this webinar as of now. So over to Sanjay Agrawal.
Thank you, Chairman CA Satish Kumar Gupta ji of the International Tax Committee. We have also with us our council member and vice chairman CA Vishnu Agrawal ji and the speakers of the day, moderators and the office. Let me tell you, incidentally, because of certain other work, I was in the council. So Satish Bhai has found me here and he said, you should be here because this committee was headed by me for 2-3 times in the past. Friends, let me tell you, the topic which the committee has chosen is a very apt topic and it always remain in the controversy. And as such, the nuances of this particular topic on withholding tax under 195 and the new income tax act also, there are a lot of complexities. Which form is to be filed for the payments which have been deducted till 31st March and which forms are required to be filed which are deducted in the post March. So these are some of the queries which normally viewers are asking in the first week of April, now in the second week of the April, and then in the first week of the May also. So the speakers of the day, they are the well established and they have done their practice in this particular field of the international tax itself. So friends, not taking much of your time, as already chairman has informed, there are more than 1,000 participants which are participating in this particular webinar. And this series which the committee is doing, it's absolutely a new thing because in the physical program, sometimes we are not in a position to reach and there is a lot of other things. So webinars are the best way of expressing the things. So I'm thankful to the committee for all these things. Over to Chairman. Thank you very much.
Thank you, sir. Thanks a lot for coming and for addressing our member. Now I would request my vice chairman, but over to Sankalp, please invite vice chairman.
Thank you, sir. Thank you so much. Now I would request CA Vishnu Agrawal, sir, for to enlighten us with his words.
Thank you, Sankalp ji Pitliya ji. Respected the chairman of the International Tax Committee and my elder brother in the Central Council, CA Satish Gupta ji, senior Central Council member, and we always say the Guruji in the taxation and in the council, my elder brother again, to whom I have learned so many things in the council. And friends, only I want to say, entire life he has given for the profession in this regional council, in the central council. So each and every penny time he has given for the profession. That's why we are coming here this stage. And from last year, he was the chairman of the International Tax Committee. And last year, the International Tax Committee was formed the first time, because before that, Direct Tax Committee and International Tax Committee were jointly working. And last year, the president C.S. Nandaji has thought that this committee has lot of initiative inputs. So Sanjay Agrawal ji is the right person for the chair this particular committee. Friends, he is the most of the senior person, and he has vast experience in the direct tax and the international taxation, and entire life he has given in the council. And today we are fortunate that he is available for the giving us the suggestions and opinions to the our committee. Friends, I request each one of you, all my 1,000 member present here, once join hand for our Sanjay Agrawal ji, because he has, and today whatever we are in the international tax committee, because of him, and we are only following his footprints for the next, for the all each and every initiative taken by Sanjay Agrawal ji. Friends, as good as our Satish Gupta ji has also given each and every penny time for this particular committee, in spite of he is chairman of the aggregation of the CA firm also, and the vice chairman of the board of studies. Friends, today we have chosen this particular topic because a lot of controversies already Sanjay Agrawal ji has told us that lot of controversies in this particular field, because TDS only this particular any section where sometimes it is opinion that whether this particular tax is deducted or not, someone is says yes and someone is says no. But today we have with us Piyush Bapna ji, and I'm sure crystal clear that he will again crystal clear about the fundamental of the subject. Friends, uh, but this year, jointly with the Direct Tax Committee, we have came out with the Income Tax Act 2025, the second edition, and the Income Tax Rules also first edition. So I request each one of you take the maximum benefit. The combo price is only 1,200 of the rupees. Friends, one more my request to every CA firm, because I am also chairman of the peer review board. Uh, Up to 31st December 2026, if your firm is having three and more than three partners, and also doing the listed company audit and the public companies where public fund is involved, friends, if your firm has not gone under through the peer review, my request to each and every firm, immediately you file the form 1A, and you will get three numbers of the three name of the peer review, and you select one name in the three out of the three name, and you send to the peer review board, and immediately, friends, you go through with the peer review. Otherwise, from after that, if you will not complete up to 31st December 2026, all the legal consequence will be followed. Friends, I will not take much of the time because our senior leader is here, Satish Gupta ji. With these words, I thanks to each one of you. Only one thing again I say, that every Wednesday we are doing the good program for the web in form of the webinar. I request everyone, please join, because every time we are inviting good to good speaker from the country. With these words, I thanks to each one of you. Thank you, friends.
Thank you so much, sir. Now I would like to request CA Satish Gupta sir to give his welcome address.
Thank you, Sankalp. My
Thank you, sir.
brother in the Central Council, or to whom Vishnu Bhai has just recalled my memory, that he told the Jagat Guru. I tell him the Jagat Guru Shankaracharya Vishnu Bhai. And so Sanjay Agrawal ji is really wonderful person, and a very person having a vast knowledge, great knowledge, and very cooperative, very helping. And we are lucky that today he is here. And my brother Vishnu Agrawal ji, who is vice chairman of this committee, but chairing a very important committee of the institute, that is peer review board, a regulator. And friends, believe me, the changes he is coming up with in peer review board this year are miraculous changes and are the far-reaching, have the far-reaching consequences. So his request should be accepted that whoever is interested in peer review, let him apply. Otherwise, they will have to follow the automatic route, and that will be a wonderful experience, definitely. But still, they should apply in the right now, so they will be in benefit. They will be in a position of the benefit. So, and my dear friends, today we have a speaker, a very renowned and distinguished speaker, CA Piyush Bafnaji, who is helping the committee in drafting a very big publication this year. Moderator and the chairman of the Bharatpur branch of ICI, Sankalp Pitalia ji. And my dear friends who are attending this particular webinar in a very large number. It is a very big number if we cross the 1,000 marks, and this is our 11th webinar this year, and we have a target of more than 50 webinars. So I would suggest, I seek your suggestions that which topics we should cover. I seek your suggestions that which speakers should be covered. And if you want to become the speaker, you are most welcome. Kindly show your expression of interest to the committee. Committee will connect with you, and definitely if you are eligible for speaking in the webinar, they will definitely invite you, and they will rather feel happy to inviting you. So this is about I can brief. Second thing, the topic of the day is very important, as rightly enumerated by Sanjay Bhai, where the rate is always issue of litigation. And what I believe that withholding concept is loved by the government, not by the deductees or the deductors. So it is always an issue that the thing which are not loved by two parties is always a problem. So withholding is always a problem, and having a technical difficulties makes it more I can say more problem, a greater problem. So this is something I want to say about the topic, and the speaker is really wonderful, having a full of knowledge, and after hearing him, all shall be benefited, and all the concept on this particular topic shall clear to our mind. So this is something about Piyush Bhai. What I would like to say, my dear friends, about the committee today, that in committee we have 3 courses, very important courses. One is the post-qualification diploma courses in international taxation. Other 2 are the certificate courses, certificate course on UAE corporate tax and certificate course on the direct tax on the USA. So these courses we have and going very well. Whenever we launch it, the applications come and it is filled. So if you are interested in doing these courses, just check regularly the website of the International Tax Committee, and whenever we declare it, join the program after getting registration. What I want to say, my dear friend, throughout the year you will find the course. This is my promise as the chairman of the committee. Throughout the year you will find the course. So just when we start, kindly check that date. Another thing which I want to say, we are coming up with a certificate course on UK direct tax. We are also coming up on a certificate course on Singapore, Malaysia, South Africa, Australia, and Saudi Arab tax system. So just try to understand why we are coming up with so many certificate courses. What we want, my dear friends, our members have not adopted international tax practice as their core practice. Only few members are doing this practice. Even we are in dearth of the speakers on the topics. So we are trying to make aware all our members throughout the country what opportunities international tax system has. And there are a big opportunity, my dear friend. Yesterday I was sitting with a very senior member of judiciary. It just suggested me, Satyaji, why do you not come up with the certificate course on transfer pricing? So this is when I discussed with him, I was really went into thoughtfulness that yes, it is also required, because in post-qualification diploma in international, we go in the details. But if we restrict ourselves on transfer pricing, or for 2-3 days we come up with a course, whether certificate or otherwise, it may really benefit the members. And what target we have, that we want to add 10,000 new members to the practice of the international tax this year. This is our target. And believe me, on 12th of February, 2027, we will get that number of 10,000 new members awareing themselves about the international tax. This is our target, and we will achieve definitely this year. So this is our target, my dear friends, and I have already requested you to come up, show your interest to become faculty, show your interest to become writing some publication or proofreading of the publication, etc., whatever interest you have, and give your suggestion in about the organizing the different type of program. So nothing much, because Speaker Piyush Babanaji is, I don't want to come in between him and you people. So over to Sankalp for the further proceedings of this particular webinar. Sankalp,
Thank you, sir. Thank you, Satish sir. Now I would like to read a brief introduction of CA Piyush Bafna sir. It is a privilege to welcome CA.
Just
Yes,
a
sir.
minute. We have crossed the webinar members attending webinar 1517.
Oh,
it's a very big
great.
number, Piyush bhai,
Great.
and it is because of you.
CA Piyush Bafna sir is a distinguished chartered accountant and advocate with over 10 years of specialized experience in income tax litigation, international taxation, transfer pricing, and corporate tax advisory. He is an AIR holder in Diploma in International Taxation conducted by ICI and has also completed ADIT from the Chartered Institute of Taxation, UK. CA Piyush Bafna sir is a noted author, faculty, and speaker at various professional forums and has contributed to several publications on international taxation and digital economy. We are delighted to have him with us today to share his valuable insights and practical expertise on the subject. Sir, over to you, Piyush sir.
Thank you so much, Uncle. I hope I'm audible.
Yes, sir.
Yes, thank you so much for the kind introduction. And thank you so much to Satish ji, our chairman, for the very generous remark that it is because of me. I am fully aware that it is because of the ICI and ICI's standing audience is here. With this, let me just share my screen and I'll start the presentation. Sankalp, just confirm the screen is visible?
Yes, sir. Screen is visible.
Yes. Okay. So, good afternoon, all my dear participant friends, for today's discussion. Let's make it interactive because the topic itself is very practical. So we are going to discuss, first of all, the foundational principle of Section 195, then the issues which we face, some practical and major issues we face in 15 CACB, and some changes which have happened in the new Income Tax Act. And then we will also touch upon some controversies which are related to the rates, applicability of SES, and some DTAA overplay. And in the last section, we are going to go into litigation insight, where we will go into the recent judicial pronouncements of 2025 and 2026 dealing with the international tax arena, which is shaping and which is going to shape our interpretation of Section 195 while doing the advisory or while performing the 15 CSCB work. At the outset, I would like to say the sections referred in the today's presentation is old section of Section Income Tax Act 1961, Section 195. Even the form mentioned is 15 CACV. Wherever there is a corresponding change, if any, that will be highlighted. Otherwise, on broad comparison, the framework of 195 into corresponding new Income Tax Act and 15 CACB into new form 145 and 146 broadly remains the same. So we will focus on the issues so that we will be benefited while performing our duties. With this, let's start with the first section 195. Before section 195, we have to understand section 195 is not operating in isolation or a standalone provision which provides for taxation of a non-resident. And it gives a overarching power to the government and put a duty on the payer to collect the taxes at the first possible instance. Why? The reason we have section 195 withholding tax requirement put on payer is fourfold. Before the money goes out of India, government wants to collect its taxes, because once it goes out of India, government may not have chances, or it will be difficult for government to collect the taxes. Second, non-residents may not have the sufficient Indian assets to recover the money if the dispute arise in future. So earliest point in time, government want to collect that. And that is the reason section 195 becomes the primary provision for collecting these taxes. And the coverage of section 195, they have kept it so wide that even the payment which are of personal nature or say non-commercial nature, but if tax angle is involved, then we have to undertake the tax withholding. Friends, this is the broad overview of section 195. It is divided in 7 subsections. The first and foremost section for us is section 195 subsection 1, which gives us the scope of this section and conditions on fulfillment of which tax withholding is required. All these provisions we are going to discuss in detail in our subsequent slides. Since many times it is possible in the international tax cases that you may not with confidence say that, okay, whether this payment is liable for tax or not. So who will decide that? So government gives us this option under section 195 subsection 2 that you can make an application to AO and he will determine it for you. 195 subsection 3 gives the same option to approach the tax office to the payee. He can approach and he can get that certificate. And 194 and 5 are the power given to the CBDT for implementation and the validity of the certificate issued. Important for us will be Form 15CA CB, which comes from section 195 subsection 6, and last is 195(7). Friends, the charge under Income Tax Act, as we all know, is section 4. The charge once created, the taxation is applicable on the total income, which is defined in section 5, which is called as scope of income. However, scope of income depends on 2 important things. One is your residential status, and then whether there is accrual or deemed accrual. Residential status, as we are aware, is dealt by section 6, and whether accrual or deemed accrual, for deemed accrual we have section 9, which deems in certain situation where the accrual is happening outside India, the deeming is presumed to be in India. Mind you, and we have to keep in very clearly in our mind that section 9 never deems non-income as income. Okay, it can only deem the situs or the place of accrual. If it is, say, for example, in USA, by deeming fiction, they can make it in India. But if it is not income at all, section 9 does not help to department. Secondly, section 9 does not deem accrual in year 1 as a deemed accrual in year 2. That means if accrual has happened, say, in year 1, by virtue of section 9, you cannot, or the revenue cannot tax you in year 2 by invoking the deeming fiction. So it is only qua the situs of the transaction or the income. And to effectuate this now, charge on non-resident, we have this section 195, which places the duty on the payer to withhold the tax if there is some chargeable to tax. And its compliance mechanism is given in Rule 37BB through 15C and CB framework. So, sir, friends, who is covered in section 195? Any person making payment to a non-resident or a foreign company, they are covered. So resident, non-resident, individual, HUF firm, all are covered. Whether you are making payment to a non-resident in India or outside India doesn't matter. For example, a non-resident have an agent in India and you are making payment from India to the agent in India. One may argue that I am not making any payment outside India. So why section 195? The law is very clear. Law says agent of a non-resident is payment to non-resident. So section 195 gets applicable. One interesting point, before Vodafone judgment, the understanding was, and the Vodafone judgment confirmed that understanding, that any person, the liability or the onus of withholding tax does not include non-resident. So for example, one non-resident making payment to another non-resident, the view was section 195 is not applicable to a non-resident. After the Vodafone, which has confirmed this understanding, the government amended section this 195 and introduced an explanation wherein they say any person also includes non-resident. So to cover a situation where a non-resident is making payment to another non-resident and income is getting accrued or deemed to be accrued in India, in such case, even non-resident has to undertake compliance under section 195. I have just given the observation of Justice K.S. Radhakrishnan in the Vodafone judgment, wherein he said non-resident should not be covered, and to overcome that, they introduced the explanation. Which are the important conditions for triggering this withholding under section 195? First, there has to this withholding is to be done as we do for domestic payments. Payment or credit, whichever is earlier, you have to do it. But on what? The condition is there has to be some chargeable to tax under the act. So whenever you're making payment to a non-resident, there has to be something which is chargeable to tax under the Income Tax Act. Unless that charge is what you can say fructified or crystallized through section 5, read with section 9, the section 195 does not come into picture. Most important, this section 195 does not apply when you are making payment to resident but not ordinary resident, because they are not non-resident, and section 195 only applies to non-resident. Section 195 also applies to recurring transaction as well as one-time payments. So for example, there is a capital gain, you are making payment of sale consideration to non-resident person, section 195 applies. And whether you can adopt a position that we have section 90 subsection 2, which provides that if the provisions of act are beneficial, you can choose the act provision, else the provision of DTAA, double tax avoidance agreement, may apply. So whichever is beneficial provision you can choose. So this Patni Computers Pune Tribunal has given this proposition that act or treaty position you can apply year on year basis and on transaction basis. So for example, you are having two transactions in a year, one transaction of capital gain, their DTAA provision is more beneficial, you can apply that. And you have other transactions of interest income wherein domestic law provision is more beneficial. For interest, you can apply the domestic law provision. And year on year basis, you can change. So if this year you have adopted a position that treaty may apply, next year you may say, no, I want to be taxed under the act because it is more beneficial. So year on year basis, you have to evaluate, and transaction on transaction basis, you have to evaluate the applicability of DTAA or act. Friends, as I said, some chargeable to tax is the triggering event or section 195. It refers to any payment which non-resident is receiving which has income element in it. Okay, so if a person who is receiving the payment is not an income per se, then section 195 will not get triggered. So for example, pure capital receipts, nothing to do with anything. For example, your fund is there and you are just repatriating it. It will not attract section 195. Or say agriculture income. Agriculture income, if you are repatriating, it is not taxable, chargeable to tax under Income Tax Act. So section 195 may not apply. The common examples of section 195, as we all aware, are royalty, interest, fee for technical service, or business income, or software payments. There are plenty. This is, I have briefly explained that provisions of Act or provisions of treaty, double tax avoidance agreement, DTAA, whichever is beneficial prevails. Okay. Now the question arose, what if I am making a payment and that payment is composite? So it has some element of non-income and some element of income. What will happen? Some taxpayers have taken a position that in such case of composite payments, Section 195 mechanism fails, not liable for Section 195 withholding. Courts have clarified that even if there is partial income character into the particular sum which you are repatriating, then you have to undertake the withholding tax mechanism under Section 195. And second, most important, the term uses sum chargeable to tax, not income chargeable to tax. And so courts have interpreted that this word sum is broader and wider in its connotation than term income. So it can also include the gross amount which you are repatriating. Because as you will be aware, we have a special regime for taxation of royalty or FTS or these kind of payments where we can withhold taxes at gross level. So if income word would have been used, there would have been problem of taxing these kind of payments at gross level. So they have used the term sum. So it's a broader in its context and content. What if the transactions are happening in kind? For example, shares of one company, in exchange of that, you are getting shares of another company. So actually speaking, there is no payment happening. Constructive payment is happening through exchange or a barter cases, for example. Whether they will be also covered Section 195? Yes, they are also covered because income element is there. If there is no income element on this barter transaction or exchange transaction, then you will be out of Section 195. But just because the mode of payment is kind will not absolve your liability or responsibility under Section 195. And when we are to determine whether I am making the payment which has a characterization as a income or which has a characterization as a capital receipt, whose point of view I should keep in mind? Because AC may be stock in trade for a AC company, but a person who is receiving, probably it's a capital asset. So whose perspective I should keep in mind? So Section 195 purpose, it is always the viewpoint of pay, the recipient. From his point of view, we have to evaluate what is the characterization of that particular transaction. If that characterization is income, it will drive into chargeability, and that chargeability will lead us to withhold taxes under Section 195. This I have touched upon. It is payment or credit, whichever is earlier. So what happens if there is advance payments? So in case of advance payment, you have to determine what is the underlying income chargeable to tax. And on such advance payment, you cannot say, Acha, final invoicing will happen later. At that point, I will do. No, if advance payments are happening, we have to comply with Section 195 at that point itself. Similarly, if there are deferred payments, deferred payment will not your liability to postpone the TDS compliance at later point in time. You have, when you are booking the expenses and income is getting accrued in the hands of recipient, at that time only you have to undertake 195 compliance and you cannot defer it. There is some exception to it in the hands of non-resident, paid versus payable controversy, which will come in subsequent slide, and I'll touch upon that. Now, next point comes is, yes, I think it is here only. In income tax, the income gets accrued on, there are two ways. Income can be accrued to you or you can receive the income, right? DTAA generally uses the term paid, that whenever the say royalty is paid to a person, then that will be taxable. We have this section, the term paid defined in section 43 subsection 2 of our Income Tax Act, which says it includes both actual payment as well as paid is include payable also. So accrual as well as receipt basis. Friends, DTAA has one article 3 sub article 2 which provides that if any term is not defined in DTAA, in such case, you can take the meaning from the domestic law definition or provisions. However, unless context otherwise requires. So if context requires you to interpret a provision in different manner, then you need not import the meaning from domestic law. On this point, that royalty or FTS clauses or interest clause use the term paid, the judiciary has interpreted this term. We have this Bombay High Court ruling of Siemens Acti Shaft versus CIT. They said, and in the context of India-Germany double tax avoidance agreement, that taxability will arise in the hands of recipient only when there is actual payment. So if a payer is only booking the expenditure and not making actual payment, the term paid is not satisfied as per DTAA, and hence that sum is not liable for taxation in the hands of non-resident. So we have to keep in mind this very important principle that on payment basis, taxability can be triggered in the hands of non-resident, and accordingly, Section 195 compliance has to be undertaken. Next important point, Section 195 says you have to do the TDS as per the rates in force. So TDS may be deducted as per the rates specified under the Act, rates in force, or rates of DTAA, whichever is beneficial because of Section 90 subsection 2. We also have this provision, Section 206 AA, which says that if payee does not furnish his PAN number, in that provides a royalty payment, tax rate 10%, but the PAN number is not there with the payee, then tax has to be deducted at 20%. So higher withholding tax rate is given for non-PAN cases. We will see in the subsequent slide as to how to tackle that situation. And when you are applying the DTAA being more beneficial, to avail the benefit of DTAA, that non-resident has to provide tax residency certificate to the payer as well as Form 10F. I will also touch upon in the subsequent slide. There is slight and big change in Form 10F versus Form 41 under the New Income Tax Act 2025. Earlier Form 10F is required only when the content of TRC were not sufficient to cover the content of Form 10F. If all the contents are there in tax residency certificate, you need not file Form 10F again to claim the DTAA benefit. But now under the New Income Tax Act 2025, read with corresponding rules, now filing Form 10F is mandatory if you want to claim benefit of DTAA. So irrespective of whether the TRC is sufficient in its content or not, you have to mandatorily file Form 10F to claim benefit of DTAA. So for all non-resident who are going to claim the benefit, Form 10F now will be a mandatory condition. Then we have this Section 206 AA subsection 7, which gives some leeway that in an enumerated list, if your case falls in any of those lists, then you need not withhold taxes at the additional rate of 20%, and you can still do the tax withholding at a normal rates. We have a subsequent slide to deal with that. So this rule 37 BC provides that if you are making any payment to non-resident, which is of the character of interest, royalty, fee for technical service, dividend or capital gains, and you don't have a PAN number, but you provide instead of PAN these details on right side, that name, email ID and contact number of that person, address of his country, tax residency certificate, and the TIN, tax identification number of that particular person, then despite you don't have a PAN number, for this 5 type of payment, you can apply the DTAA benefit and you need not withhold at 20%. Okay. Mind you, this provision is not applicable for payment for business income. So if there is a business income, this provision will not help you. Friends, the controversy arose. Section 206AA provides you the tax rate of 20%. DTAA provides you lower rate, say royalty FTS 10%. Then which rate will prevail? And section 90 subsection 2 provides that whichever is a beneficial provision, treaty or act, that will prevail. Only provision which gets overridden by section 90 subsection 2 is section 90 subsection 2 capital A, GAR provisions, jahan pe they say notwithstanding anything mentioned in the act, that if there is a cases of GAR, then 90 subsection 2 may not be applicable. This kind of overarching non-obstante is not there in section 206 capital A. So the question is, if I don't have a PAN, whether I can take a position that still I can take the benefit of DTAA rates. So the answer courts have held, Ahmedabad ITAT decision is there, wherein they have held that yes, 206 AA provisions cannot apply if non-resident is providing TRC and satisfying the treaty conditions, then DTAA will be applicable and section 206 AA provision will not apply. The second point then arose is rates in force. The term used in section 195 also includes obviously surcharge and cess. So say 206 AA rate is 20%, with surcharge and cess is go up to say 21% or 21.80%. The question arose whether surcharge is to be levied or not. And then the question was answered in the special bench of Hyderabad Tribunal in Nagarjuna Fertilizer, wherein they have held that DTAA rate will prevail over section 206 AA rates. So no surcharge, no cess will be applicable on the DTAA rates. The rates given under the DTAA are all inclusive, including surcharge, including cess. So if DTAA says rate of 10%, then flat 10% will be the rate. You need not calculate surcharge and cess over and above that. So this situation emerges based on our discussion. If you have no PAN, no TRC of a non-resident, you have no option, tax rate at 206 AA 20% plus surcharge plus cess. You don't have PAN, but you have TRC and DTAA benefit is available, then you can take DTAA benefit as per judicial rulings. You have a PAN plus TRC plus DTAA, so whichever is beneficial, that provision you can apply. You have a PAN, but you cannot use DTAA. In that case also, you have to apply the domestic tax rates, section 237, rates in force. This I have already covered, so I will not go into that. Even this 195 obligation is applicable on non-residents. Friends, it's a duty of the payer to determine the taxability of payment being made to pay and accordingly assess. Why? If you don't do it, all the consequences provided in the act are equally applicable to pay. Like his expenses will be disallowed under section 40AI. He will be assessed in default. Then there will be interest. Then there will be penalty. In worst case scenario, there can be prosecution as well. So independently, whatever action department can take against the non-resident, even the payer will suffer the consequences, and hence due diligence of payer is of paramount importance. So whenever you are in doubt, for example, you are making payment to a non-resident, whether this is taxable or not, first of all, you have to critically evaluate that position and come to a conclusion whether it is taxable or not. But for example, say you are not able to come to a conclusion, or you have come to conclusion but there is ambiguity, or the judicial position is not very clear. In such case, it is always advisable to later on avoid the disputes or prove the bona fide of the taxpayer, that you should take the opinion of the any expert in international tax on a particular transaction, that he has given the opinion that in such facts it is taxable or it is not taxable, chargeable to tax, and accordingly discharge your owners. It helps a lot later on to prove your bona fide and defend the cases. So this is 195.1. Now we come to 195 subsection 2. Many times it happens you are making a payment of say 100 rupees. That 100 rupee payment is $100 payment. It is for purchase of goods, rendering of some service, as well as for some personal purpose, reimbursement of some cost. The question is, in such situation, not entire $100 is taxable or may result into income of the recipient. But then you are not able to determine as to what is that taxable component from this composite amount which I am paying to the recipient. In such case, law itself provides you the option in subsection 2 of 195 that you can make an application to AO. AO will determine which portion, how much portion of the amount or sum you are going to repatriate is chargeable to tax in India. For this, he will examine the facts. He will go through the agreement terms and all those things, and he will determine the taxable portion. Only on that portion you have to undertake the withholding tax obligation. Right? So this is very important safeguard provided in the act, because there are many contracts wherein there are lump sum payments, EPC contracts or the turnkey contracts. Therein the both elements are merged. Taxable, non-taxable, capital income elements are merged. So you don't take, because as a payer, you cannot be very aggressive for someone else's compliance. Then law provides you option to approach the tax officer, assessing officer, and get this determination done and then comply. Once you comply with section 195(2) as per AO, then you can never be treated as assessee in default. That's the major benefit you get of section 195 subsection 2. When you can invoke, we have discussed when there is a composite payments or goods or services are both involved payment, then in such cases this is a very appropriate remedy you can apply. Then there is circular issued by CBDT, circular 3 of 2015, wherein they say to determine whether any amount is chargeable to tax or not, irrespective of fact that the taxpayer or the payer has not filed any application under section 195 subsection 2, AO should always determine the taxable income component in the payment. And by default, he should not assume that entire remittance is taxable, an income component. He should determine how much is a chargeable portion based on the facts of the case, the nature of remittance, and the context or the purpose for which the remittance is being made. So this circular is very critical for us to understand that even if I have not made any application to the tax officer, the CBDT says that officer has to be judicious, balanced, and he has to apply his mind to the facts of the case to come to conclusion as to how much amount is chargeable to tax. Friends, these are the three rulings which have really shaped section 195. The first one is of GE India Technology. It's very important. It says obligation under section 195 arises only and only if that payment is chargeable to tax in India. If payer is able to demonstrate that the payment which I have made to a non-resident is not at all chargeable to tax in India, then there is no obligation under section 195 on him to make the withholding tax payment. This aspect was clarified by Supreme Court in GE India. Prior to that, Karnataka High Court has taken a view which was there has to be a blanket TDS obligation, irrespective of it is chargeable to tax or not, unless you are going 195 subsection 2 or 195 subsection 3. If you are not going that, you have to withhold the taxes. Supreme Court has given a very clear and categorical observation. Chargeability is very important. You first determine that. If it is not chargeable, 195 is out of question. Second important ruling, and we have already touched upon to this, taxpayer used to take a position if there is a composite payment, composite sum, income element, non-income element, no 195. Supreme Court says, sir, no, this is a wrong interpretation. To the extent there is an income component, section 195 applies and you must do the 195 obligation. And if you are unsure how to chargeable portion from a composite amount, in such case, what you should do? You should always avail the provision of section 195 subsection 2. Make an application to AO, give him facts, he will determine it for you, and then you follow the law. And then last important judgment is of Vodafone. What Vodafone did, these two quotes which I have given, these are the important observation from section 195 of Vodafone, not the ultimate outcome that it was held non-taxable indirect transfer. They said the object of 195, section 195, is to ensure tax due from non-resident person is secured at the earliest point in time, so that there is no difficulty of tax collection at subsequent stage. The object they are making clear. If in law, the responsibility of payment is a non-resident, then in the fact the payment was made to agent or nominee in India will not absolve the duty. These two very important points they have clarified, that payment to agent, payment to nominee in India will not absolve section 195 obligation. Friends, with this, we come to section 195 capital A, which discusses there are many commercial instances where the recipient, the non-resident says that I want $100. Then we say, oh, there will be tax. So $10 tax. So you will get 90. He says, no, I want complete $100 to be received by me. So in such case, the law provides section 195A that you have to do grossing up. Means what? You have to back calculate. If non-resident is receiving 100, then obviously you are discharging the tax on his behalf in India. So you do a reverse calculation and accordingly gross up the original consideration or income. So we see with the example that if 10,000 is the agreement USD, that 10,000 constitute 90%. Say rate of tax rate is 10%. So this 10,000 is 90%. So how much is 100%? Is 11,111. 11,111 pe you apply 10%. So TDS comes 111, 4 times 1, 1111. So what is happening? If recipient would have borne his own taxes, 10,000 pe 10%, that means only 1,000 TDS I would have deposited. But since he want entire 10,000 rupees to be received by him, I have to now pay higher TDS of 1,111. So $111 extra TDS I am obligated as per section 195A. We have to keep in mind, this is not driven by law. This is a commercial call, which commercial call gets translated in section 195 additional tax liability. So whenever we are negotiating a contract and the clause comes that the non-resident will get payment net of taxes, that itself should trigger in our mind that acha, there will be grossing up of taxes and additional tax burden will fall on the payer. So we have seen section 195 subsection 2, the payee can approach payer can approach to the AO and ask how much is the taxable component. Similarly, subsection 3 is there of 195 where payee can go and say, sir, this is the amount based on this fact, not 10%, but the withholding can be done at 0 or say 2%. So the option is available in section 195 subsection 3. Same option is also available to the payee, that means the recipient, under section 197. You can make an application to AO, give all the facts to him, and he will determine, okay, in this fact of the case, TDS withholding rate should be 3%, and he will issue you that lower withholding certificate. And based on that, the payer will make a compliance by making TDS at 3%. So you have these avenues available. Where you are in doubt, please use these avenues available, either to payer or payee. And if you don't comply, section 195, these are the consequences. 100% expense gets disallowed. You become assessee in default. You are liable for interest. You may be also liable for additional penalty, section 221, 100% of TDS amount. And section 58, yes, if it is income from other source, even there, your expenses will be disallowed. Apart from that, there will be penalty also. Section 271C, which says tax amount equal to penalty can be levied on you. If you are not making compliance of form 15 CSCB as per section 195, then for each such default, you may be liable for 1 lakh rupees of penalty for each such default. So in say here you have issued 20 form 15 CSCB, the company, out of 20, in say 5 forms you have made incorrect filings, or you have not done the filings, then 5 lakh rupee penalty can be levied on you. And some other penalties are also there. And some section 276 capital B prosecution, generally not done, but theoretically that is also a possible outcome. So first section now we have covered. We have understood the nitty-gritties of section 195. Let's go into the practicality as to how it gets run through section the form 15 CA and CB. So friends, 15 CA CB, now under the new Income Tax Act, it has become form 145 146. Form 15 CA is a self-declaration to be given by remitter. Same remains in section form 145 new regime. And 15 CB is a CA certificate which you take if taxable income is more than 5 lakh rupees. Same remains in the new Income Tax Act. Form 15 CA used to have the 4-part structure: Part A, Part B, Part C, Part D. We will discuss those parts. The exact same structure is kept intact in the new Income Tax Act in form number 145. There are again 4 parts, same parts, which you have to comply. So what is changing? The changes are in now new form 145 146. They have predefined 65 categories for remittances and purpose code. Out of that drop down only you have to select recipient's tax identification number, his country of residence, and his principal place of business. These details you have to give. TIN, tax identification number, has become mandatory for all parts. So whenever you are making filing, TIN has to be given. And earlier, if for example the bank and your authorized dealer are not the same, authorized dealer is different bank, your normal bank is different bank, in such case you have to also give this one number, ITD REN of the AD banker, not that relevant. And now in new regime, form 146, which CA will give, it will carry a UDIN, and there will be real-time UDIN validation. Only when this UDIN validation will happen and the UDIN get consumed, then that acknowledgement number will get subsumed in form 145 part C, which a remitter is going to give. So there will be mapping of the declaration given by the remitter and the form issued by the CA, UDIN based. And they have also given a facility that you can withdraw the form which you have filed. Say there is some error you have noticed, within 7 days you can withdraw the form which you have filed. So form 15CA section form 145 in new act, it has 4 parts. Part A, if your aggregate income to a payee is less than 5 lakh rupees per financial year, you will give details in part A. 15CA form CB form not required. Second, your income is more than 5 lakh rupees, but you have obtained a certificate from AO, either section 195 or 197. Then you have to fill form part B. Your income is more than 5 lakh rupees, but you have not obtained any certificate from AO. In such case, you have to fill form part C. And there, form 15CB or form 146 of the new act, a certificate from a chartered accountant, is mandatory. And there is the last part, part D, which says if you are making payment of any amount which is not taxable at all under the act, exempt income, in that case you fill up the part D of form 15CA. There are generally 2-3 mistakes which happen when we fill this form 15CA CB. This part D is filed by taxpayers when amount is chargeable to tax, but in computation, the taxable income is nil. So for example, you have a chargeable capital gains, sale consideration 100, cost of acquisition comes 110, so there is a loss. So that means no tax is payable. But this 100 transaction of sale is chargeable to tax. So we should not be disclosing in part D exempt income. It should be disclosed in part A, income below 5 lakh rupees. Second, this 5 lakh rupees limit which is there, it is for a single pay, all transactions clubbed together. So for example, you are making payment of 1 lakh rupees each 6 times to a same payee, then you cannot avail that benefit of part A. Then it is exceeding 5 lakh rupees. You have to either comply with part B or part C as the case may be. Always see in aggregation and not per transaction basis, 5 lakh limit. This I have already explained. Next important point is form 15CA is required even for non-chargeable payments. How? Let's read the language of section 195 subsection 1. It says TDS obligation arise only where the sum is chargeable to tax. So not chargeable to tax, no withholding. But let's read section 195 subsection 6, which is relevant for 15CA CB compliance. There they say the reporting obligation arises whether or not the sum is chargeable to tax. So even if the sum is not chargeable to tax, since it's a tracking mechanism department wants to have, even for non-chargeable payments, you may have to end up making the compliances of 15CA CB. Basically part D, exempt income, which is there of form 15CA, 195 subsection 6 gives the authority to that proposition. Then we have rule 37BB, which provides the list of 33 items that if payment is happening for these purposes, then you need not follow form 15CA CB compliance, which is like LRS remittance is there, donation, if there is a family maintenance, these kind of things are there which are enumerated. The payments are happening for those purpose. You need not comply and issue form 15CA or CB. This I have already explained. If there is any incorrect disclosure in 15 CA or CB of any information, or you selecting a wrong part of 15 CA form for whatever reason, then for each of such default, 1 lakh rupees penalty is there, and not per year 1 lakh rupees penalty. Each default 1 lakh rupees penalty is there. Friends, many times we are making payment to non-resident in their foreign currency. So we have to convert that foreign currency into the INR. And for conversion, Rule 26 provides that you have to use the telegraphic transfer buying rate, TT buying rate of the State Bank of India. And you have to do it on the date of deduction. Okay. There may be cases that your date of deduction, say 31st March, and date of payment is April, and there is the that foreign currency fluctuation. So that will not amount to your TDS shortfall. This you have to keep it reconciled, and whenever asked by the AO, you can give that explanation that this is not a TDS shortfall, this is just foreign currency fluctuation. I have applied SBI TT buying rate on the date of deduction as per the rule. Another issue arises interestingly is when a NRO, so there is a non-resident, he is having a non-resident ordinary account and a non-resident NRE account. Two accounts are there. He is making payment from NRO to NRE account, his own NRO account to his own NRE account. In such cases also bankers request for form 15 CSCB. Second example, a NRO from NRO account, payment is being made to any foreign account of that particular non-resident. So say he's a non-resident of Germany. So from his NRO account in India, payment is being made to Deutsche Bank Germany. Whether form 15 CSEB will be applicable. And third, the NRE account say payment is happening to his another any foreign account. What will happen? So if we see Section 195 subsection 1 says any person responsible for paying to a non-resident, he is under obligation to do withholding tax compliance. The section language itself indicates that to apply section 195, there should be at least two persons. A non-resident making payment to himself does not trigger section 195 as per the language. Secondly, also, if I am making payment to myself, one account to another account, where is the question of income therein? There is no income. So once there is no income, there is no sum chargeable to tax. Even that test fails. And in view of this, when you are making payment to yourself, NRO to NRE, NRE to another foreign account, there should not be this compliance. However, many times bankers insist that we want, other than that we will not proceed. So we give the certifications. So for example, if department alleges that there is some inaccurate particular, you have not given complete particulars, they want to levy the penalty. In such case, you can take these defenses that first of all, section 195(1) itself was not applicable. Whatever compliance of 15 CSCB I have done, it is only for the bank administration purpose, and that cannot impute any liability on me under the Income Tax Act. Friends, with this we come to another interesting part of our deliberation now, which is some controversy related to TRC, rates and DTAA issues. Let's first delve into this form 10F. I think already touched upon and explained this issue. Now to claim any DTAA benefit from 1st April 2026 onwards, filing of form 10F is mandatory, even if your TRC contains all the relevant information which is required. Earlier, you could have skipped in the Income Tax Act 1961, but in new income tax, you cannot skip it. You have to mandatorily opt in. Second, so first controversy we want to deal is based on the Tiger Global judgment of Supreme Court, which has come. if you get a TRC, whether it is sufficient. Earlier we used to have this practice that if I am getting a TRC, I was presuming that he's a resident of that particular country, eligible for that particular DTAA with that country, and the benefit we were applying. However, Tiger Global has unsettled this to an extent. So briefly, the facts of Tiger Global were there were three Mauritian company who held the Flipkart Singapore shares. In 2018, Walmart acquired these shares, and these three Mauritian company, Tiger Global 2, 3, 4, exited. And when they exited, since they were ultimately holding Flipkart India, they said we are not holding directly any shares in India. So we claim Article 13, sub Article 4 of capital gain exemption of India Mauritius Treaty, which says that if there is no particular category of capital gains, Article 1, 2, 3, 3A, 3B, then the country of resident will have a taxing rights. So Tiger Global was essentially saying the capital gain which is arising to me is only taxable in Mauritius and not in India. They also produce the valid TRC and their category 1 global business license. However, tax office did not find it proper. They said no, we don't accept this. TRC is not sufficient. And they have also invoked the general anti-avoidance GAR provisions. We are not going into the GAR aspect of the topic, but I am on the TRC aspect. So when matter reached Supreme Court, what Supreme Court held was TRC is not sufficient or conclusive proof. TRC creates a rebuttable presumption. So when you are arguing, yes, it is a starting point for you to say I have a valid TRC, I am eligible. But if department is bringing some facts on record which are detrimental or which are proving otherwise, then you have to also prove the test which Supreme Court laid down, which is what is the substance of that entity, where is the control of that entity, and what is the commercial rationale of that entity being there in that country. Basically, the substance over form of that particular entity, and importantly, from which country the effective management is carried out. Supreme Court in the fact of this case particularly held the effective management of this Mauritius company were not from Mauritius, but from out of Mauritius. And if that be the case, TRC will not make you entitled from India Mauritius DTAA benefits. And they have ultimately remanded back the matter to the AR for deciding it further, or sorry, GAR panel for deciding it further. So for us, since we are discussing section 195, the point I want to highlight is this. A person giving you TRC is a good starting point, but not a final conclusive point. You have to understand if there are some issues which apparently you notice, then in such case, you have to go beyond the TRC and ask for some more clarification on substance control effective management to give the benefit of a particular DTAA. So what we have to keep in mind, a payer who is applying the DTAA and got a TRC, these four aspects has to be considered. That there is the payee has this genuine commercial substance. They had the independent decision making. It is not happening that Indian capital only re-entering through foreign investment. So round tripping is not happening. And the recipient who is getting the money is the beneficial owner. These aspects are also now becoming quite relevant in our analysis. Because if beneficial ownership test is not satisfied, you may not get the benefit of interest or royalty or dividend clauses. Round tripping is happening, that means you are directly exposing yourself to GAR provisions. So now these aspects are now very much important when we are discharging 195 obligation. Second issue is non-availability of TRC. We have many clients from these Europe, Middle Eastern countries, UAE, Saudi, Qatar, Kuwait. They never had the personal income tax. So when there is no personal income tax, whereas the question of obtaining a TRC, tax residency certificate. Recently, UAE has begun to issue these certificate, TRCs. Post they have introduced the corporate tax. So the question is, if I don't have a TRC or the non-resident does not have a TRC, whether they are disentitled to claim this DTAA benefit. We have a direct judgment from the Scarps Industries Ahmedabad Tribunal, which says, no, you should not directly disentitle. You should go for some other corresponding or corroborative evidences. For example, you can go, if it's a case of company, you can give an incorporation certificate of UAE to prove that it's a UAE resident. Or for example, you're an individual. How will you prove? You can give your passport, visa details, your banking records that you're dealing in the bank of UAE and you were in the UAE based on the passport. And that is how you can establish your residency without TRC. And in such case, you can get a benefit. So this is also a very important point. If you are asking for TRC, you are not getting TRC, then we should go a step further and ask for supporting corroborative documents or evidences to evaluate further. This I have already dealt. DTAA rates versus section 206AA rates. DTAA rate will prevail based on the Nagarjuna Fertilizer Special Bench ruling. So no further addition of the higher rates of Income Tax Act. DTAA rate you can apply. This also we have discussed that if these are there the payments of the nature of interest, royalty, FTS, dividend, capital gains. In such case, if you give the information on the left hand side, then even if there is no PAN number, higher rate of 20% will not be applicable. Then we have this interesting point of MFN. This is a most favored nation clause, which we have in some treaties like Netherlands, France, Spain, which says that, for example, when India entered into a treaty of a Netherlands, they said, okay, rate for royalty will be 15%. But they say, if we provide any favorable rate to any other country, say 12% to X country, then that favorable rate will also be applicable to Netherlands. That is basically most favored nation clause. So we had this treaty of France, Spain, Netherlands, and as a community, we were using it because there is a treaty, there is a protocol, and that MFN clause was there, and we were using it. The revenue carried this matter before the Supreme Court, and Supreme Court in the case of Nestle SA has given a ruling that you cannot automatically import the benefit of MFN clause, which is entered into through the protocol or which is there in the treaty inbuilt, unless there is a separate notification by the Indian government through CBDT in section 90 subsection 1. Basically what they are trying to say, to give effect to any treaty or this kind of arrangement, this notification should get merged, subsumed in the municipal laws of India. And what is the mechanism of that substitution in Indian laws? It is a notification under section 90. And in these MFN cases, except France, there was no this separate notification which CBDT has given. And hence Supreme Court has said that in such absence of separate notification, you will not get the benefit of MFN clause. And they were denied. And if you have directly applied, based on the treaty language itself, then you run the risk of section 201, assessee in default. So what is the current position? After this Nestle judgment, CBDT has notified India-Spain treaty, and the MFN clause is now applicable in India-Spain treaty because there is a separate notification. France was already there. However, for Netherlands or Switzerland or any other country, this is not notified. So when you are dealing with the treaties of India, Netherlands, India, Switzerland, you should be careful and keep in mind the ratio laid down by the Nestle and whether you are eligible for the beneficial rate of applying the MFN clause. Friends, with this, I come to last section of our talk, where we are going to discuss the recent judicial precedents which have shaped and which we should keep in mind. You may ask why we are discussing judicial precedent when we want to understand the litigation insight. First of all these cases which are there, they are dealing with the eligibility to DTAA or taxability under DTAA. And those are the relevant cases because if it is not taxable under DTAA, not chargeable to tax, then section 195 compliance is not applicable. And hence we should be aware of these judicial precedents which have happened, the ratio laid down by them, and we should be applying those ratio in the practical assignments which we are going to do in our practice. The first case I want to discuss is of the reimbursement, because this is most common in many organizations, many cases, that there is a repayment of any cost, or there is a repayment of salary cost of the seconded employees. So this is a landmark decision from the Karnataka High Court, Flipkart Internet. Facts were this Flipkart Internet is the Indian subsidiary of Flipkart Singapore. Walmart, who is the ultimate holding company of Flipkart, seconded their 4 employees under the agreement to India. Flipkart India has issued them their appointment letters, their job chart. They have also made their contribution to PF in Indian government, and they also obtained the employment visas for these 4 employees, saying that Flipkart India is their employer. And they wanted to reimburse the salary of these 4 seconded employees to Walmart USA. But considering whether there is a problem or we don't want any future dispute, they filed the application under section 195 subsection 2 to the assessing officer to say that this is not taxable, no portion of this reimbursement of salary is taxable, so please give us the nil certificate. Officer rejected this. But most important aspect is Flipkart India has already deducted TDS on the salary of these 4 employees under section 192 under a domestic law provision. 3 issues arise in this case: whether there is employer-employee relationship, whether this payment which is happening to Walmart, it can amount to fee for technical service, and whether 195(2) were maintainable. These 3 issues were there before the High Court. What High Court said? On the first aspect, employer-employee, High Court said there has to be 3 tests which has to be satisfied to say a particular person is an employer of a particular employee. What are these? Direct control, whether the employee is under the direct control of a person, entity, who is supervising that particular employee and on whose direction that employee is working. In this case, High Court said that since Flipkart India issued appointment letters, job charts, contributed PF, made their 192 TDS also, they have also obtained their employment visa. They said all the three elements of direct control, supervision, and directions are fulfilled in this case. But department made a very interesting point, an argument that, sir, if I am an employer-employee relationship, employer always have a right to terminate the employee. In this particular facts, the right of terminations is not with the Flipkart India. It is only with Walmart. And since right to termination is with Walmart, in this situation, Flipkart India cannot be considered as an employer. High Court said when three tests are satisfied, just because there is an absence of termination power of an employee, that will not be very fatal in concluding on employer-employee relationship. On the second aspect, reimbursement of that cost, High Court said section 195 subsection 1 says it is applicable, withholding tax is applicable only when there is a sum chargeable to tax under the act. If there is a cost to cost reimbursement of salary, there is no income element and hence there is no need of withholding tax. So this judgment lays down very important principle for reimbursement kind of cases, that whenever there is a reimbursement on cost to cost basis, no income involved, you can take a position that 195 is not applicable or withholding is not required. There are certain cases wherein the reimbursement is made cost plus some markup. So question is whether on the entire that cost plus markup I have to do TDS, or only on the markup element of those reimbursement I have to make the TDS. There are some rulings of courts, ITIT, which have held that only on the markup element you need to do the withholding tax obligation and not on the cost portion of it, because that is reimbursement. The Flipkart judgment have also dealt with on the last aspect, whether 195 subsection 2 application which the Flipkart India has filed, whether it was a right. The High Court has said that AO could not have rejected this application on maintainability, even the fact that entire sum is not chargeable, because what AO said 195 subsection 2 is applicable only when there is a composite payment and out of that some portion is only taxable. But what Flipkart is asking, out of 100 rupees I want to send to USA, entire 100 is not taxable. So they are not effectively asking for what you can say apportionment, they are effectively asking for nil certificate. AO said for this you have to have application under section 195 subsection 3 or 197. 195(2) is not maintainable. High Court say no, even if entire sum is not chargeable to tax, you can very well file an application under section 195 subsection 2. So this is very important point which High Court has clarified in this case. We move to the next case. Many times when the remittances are happening, this is a case about the mutual fund units which a non-resident has sold in India, whether it is taxable in India or not. So this lady, NRI from Singapore, what she has done, she has earned some short-term capital gain of 1.35 crore from mutual fund redemptions. 88 lakh was from debt funds and 46 lakh was from equity funds. AO and DRP said that what assessee argued that this is not taxable in India. Why? They say if we go to India Singapore DTAA Article 13, it has only Article 13 sub Article 4 which says if it is of shares, it can be taxable in India. However, mutual funds are not shares. So you cannot apply the clause of shares sub Article 4 to these payments. So where you are left? You are left with the last residuary clause, Article 13.5. And 13.5 says it is taxable only in the country of residence. That means Singapore and not in India. So this is the assessee stand. What AO said and DRP, AO said, your mutual fund, your investment is into what? Equity fund, investment into equity shares, debt, in, investment in debt funds or these bonds and these things. So he says this mutual fund units are deriving its substantial value from Indian assets, Indian shares or Indian bonds. And hence he treated these units akin to shares. Sorry, akin to shares. And he said, I am invoking Article 13.4. The matter was carried to tribunal. Tribunal went through these composition of mutual, also went through the definition of shares under the Company Act and securities and mutual fund unit under the SCRA Act. And they come to conclusion that shares are different and securities are different. They are not same or interchangeable. And in view of this, tribunal concluded, if you are selling a mutual fund unit in India for the treaties like Singapore, Switzerland, UAE, that position holds good now, that it is not taxable in India. It is only taxable in the residence country. So this aspect we should keep in mind. Next, same controversy. Earlier we had the mutual fund. Now we have a derivative. Here also the AO argued in the same fashion that see ultimately derivative means you are deriving value from some underlying asset and your underlying asset is in India, deriving substantial value from those shares. So that means it is a nothing but shares. And so it will go in Article 13.3a. This is a Mauritius treaty. Here again taxpayer said derivative is not shares. And they referred to in Company Act definition and SCRA definition. And ultimately in this decision, tribunal has done very detailed analysis of what is exactly derivative contract and how they are different and how they are not entitling you to ownership of the underlying asset. And after discussing this, they have come to conclusion that even derivatives are securities, but they are not shares. And once they are not share, Article 13.3a is not applicable. Only Article 13.4 of India Mauritius Treaty will be applicable, and it will not be taxable in India. It will be only taxable in the country of residence. So whenever say we are remitting this amount, non-resident earn this derivative income or mutual fund capital gain, and you are remitting back to say country like Singapore, Mauritius, we should be aware of this decision based on which we have to do the form 15 CSCB compliance. Friends, we come to a very important judgment from Mumbai Tribunal, Sky High Appeal. This is Sky High Leasing Company, sorry. It is dealing with many aspects. The most important aspect I want to highlight is the applicability of MLI, multilateral instrument. I will just give a brief background and then we will go into the facts of the case. So we all know there are DTAA. India has entered into with I think 90 plus countries. The DTAA are there. Then since 2012, all over the world, countries started saying that there is multinational companies are not paying their fair share of taxes. There is a base erosion in the country, and profits are being shifted from high-paying tax country to low tax-paying countries. They all came together under the banner of OECD, and there is a BEPS project, base erosion and profit shifting. Then OECD in 2015 came out with 15 action plans. Out of one was the MLI. So they found out some 12, 13 areas to tackle this issue of tax evasion or tax shifting or tax abuse. They gave some framework as to how the country should adopt. However, worldwide there are 3,000 tax treaties. If every country has to bilaterally negotiate their respective tax treaty, it would have taken decades to implement this. So they found out one solution and they created this MLI, multilateral instrument, wherein they said, okay, countries can give their options to OECD that which DTAA of that country they want to apply MLI provisions. The other country will also give. Then they will match whether you have selected proper options. There are options in MLI. You can choose between them. And if there is a matching, then the DTAA stands amended or say superseded to that extent by the provisions of MLI. And in MLI, there are certain minimum standards, out of which the major minimum standard was you should have the anti-abuse, the change in preamble that DTAA are not meant for double non-taxation. DTAA are meant for elimination of double taxation. So if you are yielding a position by adopting a structure that there is double non-taxation, then that was never the intention. That preamble change has happened, and they have introduced the anti-abuse mechanism that you have to select from limitation of benefit clause or PPT. The PPT is one of the minimum standard. The case in hand of Sky High, it is the case of Ireland. So we are talking of India, Ireland, DDAA. India has notified all A that we want to be covered by MLI. The issue arose before the Mumbai tribunal is officer said, I am applying since India, Ireland, DTAA is notified by India, MLI is coming into effect. So there is a principal purpose test. What is principal purpose test? If the principal purpose or the main purpose of entering into any arrangement or transaction is to get the tax benefit, then the PPT test is fulfilled and then the tax benefit can be denied. Officer says in these facts, what was the fact? The Indigo has obtained the lease of a aeroplane from this company. And we all know Ireland is the hub of this leasing industry for aeroplanes. So they have taken that lease from the SPV, Special Purpose Vehicle of Ireland. Officer says the principal purpose of having this special purpose vehicle company in Ireland is to take the benefit of India Ireland DTAA, and hence I deny you the DTAA benefit. Despite the fact the company, the Sky High, has produced a valid TRC from the Ireland. What happened? The matter traveled, came to ITAT. The first and foremost question arose before the ITT was whether MLI provisions and then particularly PPT provisions are applicable in the facts of case when there is no separate notification by the CBDT. As we have seen in the case of Nestle, they said that to apply the benefit of MFN clause, CBDT has to give a specific notification. Then only it will be applicable in India. So assessee argued in this case, sir, you have notified India, Ireland, DTAA. Okay. You have also given to OECD that I want to apply the MLI. So MLI is also notified. Okay. However, the modification which is happening to India, Ireland, DTAA due to application of MLI, that particular thing you have not separately notified. And until you notify that separately, this Article 6 and 7, that is the PPT clauses of MLI, will not automatically get imported into the provisions of India, Ireland, DTAA. The tribunal find favor with the argument of assessee on the ground that these facts are exactly similar of Nestle, and Nestle, the Supreme Court has clarified the law to give effect there has to be a notification. In this case, the notification is not there. What is there is only a synthesized text available on the income tax website. If you go on the income tax website and search for Ireland DTAA, you will get two options: comprehensive text and synthesized text. Synthesized text is your original DTAA text as modified by MLI. So department tried to argue, once I have put in the synthesized text on my website, the condition is fulfilled, that is applicable. Tribunal negative this argument by saying that synthesized text have no binding nature in law. They are merely expository compilation for the ease of reader. It will not have a legal force. And until you notify the this MLI amendments through separate notification, PPT provisions, MLI provisions will not apply in India, Ireland, DTAA. This is the ruling Mumbai ITAT has given. There are other aspects also. For now, I will skip considering the paucity of time. So main thing we have to keep in mind, wherever a DTAA is there and that particular country DTAA is modified by the MLI provisions, this judgment will be applicable. And you as a professional has to take a call as to whether this decision is correct or this decision may need, obviously the revenue has challenged it before the high courts. Ultimately the constitutional courts will decide the validity of it, but till that time if you want to take the benefit of this position you can take. Next important point is this: we face day in day out payment for say cloud computing. So this is a case of Amazon Web Service Inc. What happened? The Indian income tax department has issued the 148 notice to Amazon Inc. saying that you had received the hosting and bandwidth charges from Snapdeal, but Snapdeal has not done TDS under section 195. So these charges which you have received is the royalty or FTS, and hence it is taxable in India. So we want to tax you, and they reopened the case, made the additions. The first contention of the AO was this entire setup for the cloud computing, which involves server, data centers, the softwares, codes, and all those things, entire taken together is a scientific equipment. And what right you are giving to the customer? You are giving a right to use, or right you are giving a permission to use that particular equipment, or right to use that. So it serves the category of scientific equipment, and payment for use of scientific equipment is a royalty. Second, they say in this entire process, the Amazon is also allowing you to use that AWS marks, their content. In this process, the Amazon used to give them the their contents as to how it should be operated, what things are there, and sample codes they used to see give, so that you can build upon on that Amazon platform the further development. So they say even the IPR royalty is also triggered. And for FTS, this Amazon was also giving the customer support, some documentation support, API platforms ka support they were giving. So they said, since you are giving your documentation, codes, back office support, that means you are making available your knowledge, your technology to customer, and hence even this make available clause, which is the hallmark of India US DAA, also get satisfied. All these three contentions were negative by the Delhi High Court, and they held that for equipment royalty there has to be exclusive that equipment has to be at disposal of the user. In this case, that entire cloud infrastructure of Amazon, the customer has no exclusive control. It is only to meant to give the services. Customer cannot control or cannot exploit that infrastructure. So they said it cannot amount to equipment royalty. On using those AWS content, AWS mark, they say you are not getting any exclusive rights for which payment is happening, which can be classified as a payment for exclusivity IPR rights. So out of IPR also they have removed. On make available, they made very crucial observation that you providing the best practices, support, function, configuration help, and answering their queries is merely a support to render your service effectively. Make available is satisfied only when the person to whom you are giving that technology is enabled to apply that technology on its own in future. By giving this support or configuration help, you are not transferring any technology or skill. So make available test also fails. So friends, this judgment is very useful in the cases of this cloud computing where we have this IaaS infrastructure as a service, PaaS platform as a service, SaaS software as a service, correct? So in these cases, we have to evaluate whether it may amount to equipment royalty on the principles laid down by the High Court, whether it can amount to your FTS, fee for technical service, and accordingly when the Indian company is remitting the money, we have to evaluate. This judgment is very useful. Next important point we need to keep in mind is this: royalty arises only when there is a right to use. So say there is a copyright and I have a right to use that copyright, then the payment I am making will be of royalty. But what if I get the copyright right itself transferred to me? That means I become the owner of copyright. Then it is not a royalty. Then it is a sale of copyright, which will give rise to capital gains. Outright transfer will give rise to capital gains and not royalty. The same case of this international breach. This is for this Bandra Worli Sea Link. They appointed one UAE consultant to give that design, which they wanted to submit in tender. So they gave the design, and there was clear cut clause that this UAE consultant we will give all these designs to Indian company, and Indian company will be owner of those designs. So Indian company were remitted these 2 crore fees to UAE company. They did not deduct any tax. Ultimately, it was upheld that see who is the owner of those designs. The owner of designs is Indian company. That means designs are not used by Indian company. Designs are owned by Indian company. That means there is a transfer, outright transfer of design from UAE company consultant to Indian company, and this transaction will not fall foul of royalty clause, royalty FTS clause. At the best, it can be evaluated in your capital gain, but in this case, since it was arising out of professional discharge of services, it was a business income. Since there was no P in India of that consultant, the income held to be non-taxable. Now I'll be rushing because we have some shortage of time. So whenever we are I'm just giving the now broad principles which you should keep in mind, and you can refer to these decisions to give the final advisory. So if there is offshore supply, what do you mean by offshore supply? Delivery terms is FOB, free on board. In the foreign country only, the title and risk are getting transferred. So we have the Ishika Wajima Harima judgments and other judgments which says that if there is an offshore supply of goods, that is not taxable in India unless they are linked to the permanent establishment in India. So whenever there is a transactions of goods, many times there are offshore supply, offshore design, onshore supply, onshore design, or onshore services. Club are there, composite payments are there. There you need to segregate the offshore supply component of goods and service because it can be claimed as a non-taxable. So these are the two decisions which I have highlighted: Altrom's Transport and SMS SAMAG AG German DTAA. Then we have this very interesting ruling of Clifford Chance, Delhi High Court, where they say to calculate the service P. So service P gets triggered when you render services in India through your employees. So if you are rendering services through your employees. In this case, they were rendering through two employees. Department said it aggregated to 120 days, and they included their complete stay, day one when they entered and day last day when they exited India. Entire period they consider. Assessee argued, sir, I am not crossing the 90-day threshold of India Singapore DTAA. If you exclude the period attributable to vacation of those employees, business development activities, and common days of both the employees. If you do that, effectively both the employees are in India for only 44 days, 90 days are not breached, so service fee is not triggered. High Court has upheld this principle, saying that you have to exclude the vacation period, common days of both employees, and business development period to see how many actual days of service they have performed. And only based on that, service fee clause can be triggered. Interestingly, in this case, department also argued some employees have given services remotely from Singapore. So they say virtually, though there are no employee who visited India in that year, but there is a virtual service fee is there because they have rendered the services. High Court said there is no concept of virtual service fee in the DDAA, and we cannot read by process of interpretation a virtual service fee. To trigger service fee, there has to be physical presence of employee in India. Then only it will be triggered. So whenever you are evaluating the payments for this kind of arrangements, you have to keep in mind this principle. This is the last probably case I will discuss, and then we will move into the some Q&A which is there because we are running out of time. This so what if this is a Hayat International, a larger bench decision of Delhi High Court on profit attribution to a permanent establishment. And on the PE, I have this decision of Supreme Court, which is a landmark last year Supreme Court has given. The brief facts were of Hayat were this Hayat International entered into this 20 years strategic oversight service agreement, SOSA, with the Indian hoteliers, Asian Hotels Limited. It is for initially 20 years. It gives its right to develop and operate the hotel. They could have done strategic planning, policies, procedure formulation, even branding and etc. They used to manage. They had the power to appoint, supervise, replace the general manager, frame HR policies. Their employees were frequently traveling to India and doing regular visits to see all these things are running smoothly. And if assessee, there was also operational oversight by the Hayat UAE company. Most importantly, the consideration for giving all those services were not fixed or lump sum. They were linked to the room revenue they are going to get out of the entire business. So profit linked profit sharing was there. In this fact pattern, department alleged that the Hayat has a permanent establishment in India. Hayat said, my employees never crossed the threshold of 9 months, which is there as per India UAE DTAA. Secondly, I have no fixed place at my disposal in India. The hotels, they are not at my disposal. So fixed place fee is not there, service fee is not there. So no fee, not taxable in India. Supreme Court did not accept these contentions, and Supreme Court ultimately held that because of this SOSA agreement, which is of 20 years, there is a continuous control exercise by Hayat over the operations of India. And it is not mere advisory services, but they have gone much beyond. And they were involved into the actual operation of business in India. And hence, at the disposal test is satisfied due to pervasive control which Hayat has exercised. In view of this, they have also dealt with the other aspect and come to a conclusion that Hayat has a P in India. Friends, this decision is very important whenever you are dealing with a no PE declaration which you get, there you have to keep in mind this test which is getting broader because of Hayat. That if there is a wider pervasive control of the foreign entity over the operation of Indian entity, whether they are really in a steward capacity, advisory capacity, or they are really working and jailing into the operations and business of India. If they are, ratio of Hayat will be applicable, and despite you have a no PE certificate, probably we have to be careful to determine and come to conclusion that there is a PE or not based on Hayat principles. I think with this, I will stop for now, and I will request Sankalpji to uh, uh, suggest any questions which are there in the chat box or question and answer box, which I can take up.
Sir, first of all, thank you so much for your enlightening deliberation. Sir, this gives a very much clarity in very aspects. So I would like to have some questions. Wait a second. Sir, first question was, is payment of rent to NRI person to his NRO account, bank account in India, are we required to issue form 15 CA or CB?
It is you are required to do because it is taxable in India. So when you are remitting money to them, your NRO account hai to you can do 15C.
Okay. Sir, second question was, do I need to obtain form 10F TRC and no PE declaration from my overseas supplier in case I am making payment against import of goods?
Yes, matlab if you can obtain all these three things from your overseas supplier, it is the ideal situation. You
It
should
is the
get
ideal
it. But
situation.
most of the time for import cases, the supplier is hesitant. He is saying it is not taxable in your country. Why you want all these documents? So if
Okay.
you are able to obtain it, you should have it on record. It will be very useful to you.
So what are the documents we should be getting from the supplier?
Yes, that is what he has rightly said. TRC first you should have. Second, you should have this document with you that it is no PE certificate. No PE certificate, mind you, it is not coming out from the Income Tax Act. Nowhere it is mentioned that no PE certificate you can obtain. It is a it is a device or a mechanism which we have evolved to safeguard or prove the bona fide of the payer. That sir,
Okay.
I don't know what operation he is doing, where all he is involved, so in bona fide, when he gives me this no PE certificate, I am relying on it. But again, as I said, Hayat decision, when you know the non-resident is having all pervasive control in India, he is fully present in India through his businesses, then you cannot just rely on the no PE certificate. So
Okay.
documentary evidences, obviously you will have a clause in the agreement, FOB clause, so that offshore supply is not taxable. All these clauses will help you. But you have to also keep in mind as auditors, what you can say, the instinct which we have now, we cannot ignore the indication which you are getting.
Okay.
Documents, so these 2, 3, 4 documents are sufficient.
Okay. Sir, we can take one more query. For section 206C1F, for luxury goods, TCS at the rate 1% is required to be collected. For motor vehicles, CBDT clarified that TCS not applicable only on retail sales and not from manufacturer to distributor. However, no similar clarification for notified luxury goods. So can we use the same interpretation for luxury goods purchased by non-residents for further trade in or outside India?
Yes, you can use it. However, again, when they have not specifically given that option, the department can very well say that only to the first category we wanted to give relief, so we notified them. Other category we don't want to give. But in my view, this it's a better view to take that the same analogy should be applicable, and then the benefit you can claim.
Okay, sir. Last question. Safety report by Netherlands company who had filed Form 41 on income tax portal having no PE in India to Indian company. TDS, how much we have to deduct?
Can you repeat the first? What is the fact? payment is for what
Safety
purpose?
report by Netherlands company who
Okay.
had filed Form 41 on income tax portal, having no PE in India.
Safety report. So if it is safe, I believe there is some technical report they are giving.
Yes.
And in Netherlands treaty, I think make available clause is not there. So if you are making payment for technical service, then it will be 10%.
Okay. Okay. Sir, वैसे तो there are very many questions.
You take a call.
But due to time constraint, we have to take only these.
Okay. Okay.
Thank you so much. Thank you so much, sir.